Hello everyone and welcome back to the Web3 Daily. Let's dive into the latest market moves. Honestly, looking at the charts, it feels like the market has a bad case of indecision, doesn't it? Bitcoin is just grinding back and forth about $100,000, seemingly unable to push higher but refusing to break down. The bulls and bears are locked in a real tug of war right at this level. Neither side willing to give an inch. Ethereum is showing a little more strength, holding its ground at $4,300, but it also lacks that decisive momentum for a breakout. My take on the overall market feel is that everyone is holding their breath, waiting for a signal, for some major news to finally tip the scales one way or the other. This kind of tight sideways action can be a real grind. I get it, it tests everyone's patience. But as we all know, the longer the consolidation, the more explosive the eventual move can be. Of course, a quick reminder, in an uncertain market like this, chasing pumps or panic selling at the first dip carries the highest risk. So, let's kick things off today with a really interesting paradox. When I first saw this data point, it kind of threw me for a loop. Think about this. Ethereum's price is still hovering near its all-time highs, but its network revenue absolutely plummeted by 44% in a single month, dropping from over $25 million to just $14 million. This is where it gets fascinating. The price is holding strong, but the income got cut in half. What's really going on here? Well, behind this number lies a huge debate about the future direction of Ethereum. The root cause of all this is the Dencun upgrade. After the upgrade, it became much cheaper for Layer 2 networks to post their data to the mainnet. Gas fees went down, which means less ether is being burned. And naturally, revenue followed. This immediately split the community into two camps. The bears were all over this, saying, "See, the fundamentals are cracking." They argue that revenue is a core metric for a network's health, and a collapse in revenue suggests its value capture mechanism is weakening, which is a major red flag. They're asking how can a blockchain that isn't making money justify such a high market cap? But the other side, including many core developers, has the complete opposite take. They believe this is a sign of the network maturing. Cheaper transaction fees mean the Ethereum ecosystem is vastly more usable and accessible for everyday people. This will attract a massive wave of new users and applications, making the entire pie bigger. Even though short-term revenue is down, they argue that the network's long-term value and its defensive moat are actually getting stronger. What they want is a thriving, bustling economy, not just an expensive digital toll booth. So, this has become a fascinating paradox. What do you think we should prioritize, the short-term income statement or the long-term network effect? Which side of the debate are you on? After discussing the debate over Ethereum's long-term roadmap, let's turn to what was once considered the boldest long-term experiment in history and see how that turned out. I don't know if you all remember how incredibly excited the entire crypto world was a few years back when El Salvador declared Bitcoin as legal tender. Many people felt this was the first domino to fall, that the era of sovereign nation adoption of Bitcoin had arrived. It was seen as a historic milestone. Back then, nearly every industry publication featured it on their front page, fantasizing about how a country could use Bitcoin to fight inflation, attract foreign investment, and achieve financial inclusion. That narrative was powerful at the time, and it definitely added a lot of fuel to the bull market. And the result? To be honest, when I saw this news, it was pretty sobering. Earlier in 2025, El Salvador quietly repealed this law. Yes, you heard that right. The world's first Bitcoin nation no longer recognizes Bitcoin as legal tender. The reason is very pragmatic and almost brutally simple. In order to secure a crucial $1.4 billion loan from the International Monetary Fund, they had to compromise. The IMF's terms were clear. If you want the money, you have to abandon Bitcoin's legal tender status and re-embrace the rules of the traditional financial system. The implications of this are actually quite significant. It's a stark declaration of just how difficult it is, at least at this stage, for a small nation to try to use Bitcoin to stand against the established financial order. All those beautiful visions that were painted back then proved too fragile in the face of real-world economic pressure and international political maneuvering. Today, shops in El Salvador are no longer required to accept Bitcoin, nor can you use it to pay your taxes. It's safe to say that this experiment, which once held so much hope for Bitcoin believers, has officially seen its first chapter come to a close. The story of El Salvador shows the power of traditional forces, but the giants within the crypto world are also shoring up confidence in their own way. Recently, the fad around Tether started swirling again, with rumors spreading that they were secretly selling off their Bitcoin, which made the market a bit nervous for a moment. It all started when some on-chain sleuths noticed the large Bitcoin transfer from a wallet associated with Tether. And you know how the market is the second a whale makes a move. Speculation runs wild. Are they about to dump on the market? Is this a signal that the bull run is over? All that fear and uncertainty started bubbling up. But then, Tether's CEO, Paolo Ardoino, quickly stepped up to personally shut down the rumors. He went directly to social media to state that it was all complete nonsense. Not only has Tether not sold a single Bitcoin, he clarified, but they are continuously using their company profits to buy even more. That transfer everyone was obsessing over, it was actually funds being moved to a separate investment initiative called 21 Capital and had absolutely nothing to do with Tether's official reserves. That clarification was both extremely timely and powerful. This whole episode really helped calm the market's nerves. It reaffirmed that Tether, as the largest stablecoin issuer, not only has solid financials, but is also committed to its role as a steadfast Bitcoin holder. They are actively investing their profits into hard assets like Bitcoin, gold, and even land, which speaks volumes about their macroeconomic outlook and their deep conviction in Bitcoin as a store of value. According to the latest data, Tether now holds over 100,000 Bitcoin, making them one of the largest corporate holders in the world. In a market filled with uncertainty, knowing that a whale of this magnitude is consistently buying is no small comfort for many investors. While Tether's actions demonstrate the power of crypto-native giants, a key player from another ecosystem is securing a major ticket into the world of traditional finance. The firm Thaw Strategies, which is focused on investing in the Solana ecosystem, has officially received approval to uplist its shares from the OTC market to the main Nasdaq exchange, where it will trade under the new ticker symbol STKE. Now, some old-school investors might not be familiar with this new name, but they might recognize its former one, Cypherpunk Holdings. After the rebranding, their strategic focus became crystal clear. They are all in on the Solana ecosystem. This move is no small feat. Graduating from the OTC market to the Nasdaq is like moving from a minor league to the majors. It signifies that the company's financial health, corporate governance, and public disclosures have all met the stringent standards of mainstream capital markets. This in itself is a powerful stamp of legitimacy, proving its strengths and transparency to all of Wall Street. The most immediate benefit, of course, is the massive exposure and the liquidity that a Nasdaq listing provides. Previously, only a handful of specialized investors would trade it on the OTC market. Now, retail investors, mutual funds, and pension funds globally, anyone with access to US stocks can easily buy and sell its shares. This opens up much wider channels for future fundraising and attracts more institutional capital. But perhaps most importantly, this is a huge boost for the entire Solana ecosystem. It effectively creates an official compliant Solana proxy stock on the Nasdaq. This provides a perfect alternative for traditional funds that want exposure to Solana's growth but are hesitant or unable to hold tokens directly. This will indirectly funnel a massive amount of traditional capital toward the Solana ecosystem, which is undoubtedly a major potential boon for all the projects building on it. If listing on Nasdaq is about opening a funding channel to the outside world, then this next story is about how the crypto world is building a more efficient and secure financial highway internally to welcome that capital. Now, you might be thinking, isn't transferring stablecoins already pretty convenient? And for individual users like us, it generally is. But for institutions that process thousands of transactions and hundreds of millions of dollars a day, it's a massive headache. They have to deal with fragmented liquidity across different chains and various stablecoins with no unified standards. They face significant counterparty risk. What happens if I send the funds and the other side doesn't deliver? And even more critically, they face a compliance minefield. Anti-money laundering, sanctions, screening. The travel rule every step is a potential pitfall that could lead to huge fines or worse. To address these very pain points, the custody giant Fireblocks has stepped up and launched the Fireblocks network for payments. You can think of it as an institutional-grade, compliant payment network for stablecoins, like an Alipay for institutions. Within this network, all participants, and there are over 40 already, including major players like stablecoin issuer, Circle payments firm, DeOco, and crypto bank Signum are vetted by Fireblocks. This allows institutions to conduct peer-to-peer instant settlements, which drastically reduces counterparty risk. But the most crucial feature is that Fireblocks has embedded compliance tools directly into the network. Every single transaction is automatically screened against sanctions lists before it's executed, and the network seamlessly integrates solutions for the travel rule. This essentially puts both a security lock and a compliance lock on institutional stablecoin transactions. The significance of this launch is that it's paving the final mile of the road for stablecoins to become a mainstream payment tool. Only by solving the core security and compliance concerns of institutions can the trillions in potential capital feel safe enough to enter the space. And only then can Web3 payment applications truly break out from being a niche product to a mainstream reality, while internal infrastructure is being built up. Some potentially good news is also emerging from the external regulatory environment. Let's turn our attention to the global regulatory bellwether, the United States. For the longest time, the biggest headache with US crypto regulation has been the conflicting jurisdictions. Is it the SEC's job or the CFTC's? No one could give a straight answer, leaving projects constantly at risk of being on the wrong side of the law or getting trapped in years of litigation. However, a recent draft bill emerging from the US Senate seems aimed at fundamentally solving this chaotic overlap. The core proposal of this draft is to establish a joint committee composed of members from both the SEC and the CFTC, specifically tasked with creating rules for digital assets. This is a fascinating approach. Instead of letting the two agencies continue their fight, it forces them to sit at the same table and work things out together. It's like moving from a situation where two departments were just kicking the can back and forth to creating a joint task force with shared responsibility. This could finally end the years-long turf war between the agencies and provide the market with a unified and clear regulatory framework. What's even more exciting for people in the industry are some of the very specific pro-crypto provisions included in the draft. For example, it explicitly states that activities like staking and airdrops, provided there's no fraud involved, should not be considered securities offering events. This alone would clear a massive legal hurdle for countless projects' token distribution and network operations. Furthermore, the draft specifically provides exemptions for DePIN, or decentralized physical infrastructure networks, for projects using token incentives to build real-world networks like decentralized storage or wireless connectivity. This is basically a get-out-of-jail-free card. Now, while this is still just a draft with a long road ahead before it could become law, the signal it sends is extremely positive. It shows that US lawmakers are beginning to recognize the unique nature of the crypto industry and are attempting to regulate it in a more rational and clear-headed way, rather than just crudely trying to shove everything into the old securities law framework. While regulation in the US is still a work in progress, smart money with a keen sense of smell isn't waiting around. They're already placing their bets with hard cash. Sora Ventures, a crypto venture capital fund with a focus on the Asian market, recently announced a massive move. They have officially launched a $1 billion Bitcoin treasury fund. The fund's purpose is incredibly pure and extremely hardcore to simply buy and hold Bitcoin. This is a completely different beast from the traditional venture funds we're used to hearing about, which invest in the equity of startup companies. This fund doesn't engage in any fancy strategies, it doesn't invest in new projects, and it's not trying to build an ecosystem. It will simply take the $1 billion it raises and convert it all into Bitcoin for its treasury. The partners at Sora Ventures have been very clear about their thesis. They believe that against the macroeconomic backdrop of continuous global fiat currency devaluation, the narrative of Bitcoin as digital gold is one of the most certain and significant investment themes of the next decade. They are no longer content with just investing in the pick and shovel companies of the crypto world. They want to directly own the core asset of this world, Bitcoin itself. The signal this move sends is incredibly strong. First, a $1 billion fund is by no means a small amount. Even in the traditional financial world, this demonstrates a powerful institutional conviction in the long-term value of Bitcoin. Second, this could represent a paradigm shift. VCs like S16s have traditionally bet on which applications will emerge as winners. This fund from Sora, however, is betting directly on the future of the digital nation of Bitcoin. It signifies the emergence of a grander, yet more conservative, institutional investment strategy. When a growing number of venture firms start treating a direct allocation to Bitcoin as a mainstream strategy, the potential impact on Bitcoin's underlying buy pressure and the strengthening of its long-term consensus is simply immeasurable. Alright, that's all for today's Web3 Daily Report. If you found this helpful, please hit that like button to show your support. Every day, we sift through the noise to bring you the most crucial insights from the Web3 world, the information that's closest to the opportunities. We hope that by curating this content, we can help you make more rational and informed decisions on your Web3 investment journey. Also, I've dropped exclusive registration links for major exchanges in the comments section below. These are special high rebate deals we've secured for our viewers, which can help you save on some of the costs along your investment path. Let's all continue to stay rational in the Web3 space, move forward steadily, and build our wealth step by step. May everyone's crypto portfolio grow steadily. We'll see you tomorrow.